Horlicks Network 18, Mission Poshan, Bhavishya Roshan.
The first rate hike in nearly 4.5 years is here. But the unanimous decision by the Monetary Policy Committee did not spook markets because the MPC maintained its neutral stance. The inflation projection for both the first half and the second half have been raised, but only by about 20-30 basis points. The central bank also flagged off some upside risks, but it did not scare the market. Further, in a bid to provide some liquidity cushion to banks that are raring to lend, the Reserve Bank has increased what you call the LCR carve-out from the statutory liquidity ratio. What this effectively means is banks will have a little more room to lend to customers, provided, of course, they have the capital and the deposits. On growth, the Reserve Bank said it sees sustained revival in economic activity, in quotes. It expects investment activity to remain robust, even after admitting that there is some tightening of financial conditions. So that's positive when a conservative central bank says that growth remains at 7.4%. Before we bring in the experts, here's the governor himself explaining the rationale behind the neutral stance, even after raising the inflation forecast and hiking rates.
Neutral stance leaves all options open, and other central banks also do the same. So there is no contradictory, there is no difference or there is no tension between the two. The committee felt that there was enough uncertainty for us to keep to the neutral stance and yet respond to the risks to inflation target that have emerged in recent months.
Okay, so that's in sum the rationale. Joining us now to discuss this policy and the other attendant announcements with respect to banking regulation are Manish Madhavan, Managing Director at HSBC India, PK Gupta, Managing Director, State Bank, JP Morgan's Chief India Economist, Sajid Chinoy, and Shriram Transport Finance's Umesh Revankar. Gentlemen, thank you very much indeed for joining me. Well, first to the Economist. You think it was a great negotiating game, Sajid, within the MPC? You saw the governor saying, okay, Mr. Dholakia, I'll do the rate hike, but on your behalf, I'll keep the stance neutral. And you tell Viral and Patra that for your sake, I'm hiking rates, but I have to keep the flock together and so neutral. You think this is a great game of managing the MPC?
No, I would not overread that. I think what's impressive is we had a unanimous decision today, number one. Number two, the RBI has clearly taken cognizance of the inflation risks in the last 2 months. And number three, you know, everybody around the world had said that inflation targets really get tested when central banks are prepared to raise rates to meet their target. So the fact that the central bank has moved proactively to guard its 4% inflation target over the next year, I think is very credible, is very impressive. I think that's what we should focus on. I think let's not get too hung up over neutral versus a tightening stance, because frankly, a neutral stance did not preclude the RBI from raising rates today and will not preclude the RBI from raising rates in the future. That's the most important point. I think what the central bank was trying to communicate was, in an environment where monetary conditions have already tightened so much, there was no real useful need to scare markets by signaling that they're on course to a series of rate hikes. I don't think the data flow would support multiple rate hikes. We believe there's one more hike perhaps in the pipeline in the next couple of meetings. And given where global conditions are, oil prices are moving $2-3 every day. Who knows what's going to happen in a couple of months? The central bank should keep all options open. I think I agree with the governor. There's no contradiction here between being neutral and raising rates. And therefore, that does not preclude a rate hike in the future as well.
Okay, I'll come to you on what this can do to the loan market as well. But first, that to the banker who has to make that decision. Mr. Gupta, there are several things for banks in this policy. There is, of course, the rate hike, but there is an LCR carve-out. There is as well state government securities which now have to be marked to their true value and not just 25 basis above G-Secs. So net-net, does it leave banks a little poorer?
No, I don't really think so. See, I tell you, see, first of all, this rate hike that happens actually, okay, if you look at the overall market, as of today also the market is in surplus liquidity mode. I don't really think it gets transmitted onto the deposit rates or to the lending rates immediately. But you know, that is more a function of each bank's liquidity position. That is how the banks have been raising their rates, and other banks have been following them also. So I think it will take some time before it really gets transmitted onto the deposit and lending rates. As far as the the LCR, that 2% additional carve out that has been made, actually, I think that is a part of the overall transition mechanism which RBI has been following for a long time. I think now we have already reached up to 13%. So if you look at it, your total SLR requirement is 19.5, and 13% is getting used for the purpose of LCR. So I think it's a question of time when we have this entire thing getting met out of your LCR requirement. Again, I think the overall market is still surplus there. I don't really think that any major bank has a problem on account of LCR. But yes, you are right. There could be a few private sector banks who could be running a little short on liquidity. So to them, of course, it will be a little bit of a help that will come actually. But I think for most of the other banks, this will not have any immediate impact. But this mark-to-market of state development loans, I think will have an impact on most of the banks. As of now, as you know, that 25 basis points above the government securities, the mark-to-market is done. Actually, now the market rates are generally between 40 to 50 basis points above the G rates. So there will be some hits that the banks will take. But again, they have said that, okay, it could be spread over the 4 quarters. So I think if the banks do make use of that dispensation, so the impact on the quarterly P&L for this quarter may not be much. But yes, there will be some impact that the banks will have actually.
Okay. Well, somebody was making a very big calculation. What is it, 8 lakh crore of outstanding SDLs, and therefore the losses could be big. I don't know exactly how it would be distributed. But Manish Madhavan, before I come to the SDL itself, your holistic takeaway for the bond markets, some good, it's only neutral stance, but at the same time, some SLR demand will dry up because of LCR. What is in this for the bond market? Any relief at all?
I think I'll, before commenting about the bond market, I would say the rate hike which has happened was, it was an expected lines. A lot of analysts had expected this, though maybe in August and later, but it has got manifested now itself. It's a step in the right direction in the sense it's a preemptive kind of a rate hike, and as Governor has pointed out, the circumstances are such that they took this call because all the risks which were mentioned in the April policy have got manifested. I think 5 or 6 of them what they mentioned at that point of time. Now coming back specifically to bond markets, I think last April policy, when I was on your show, the 10-year yield was at 715. Today it closed at 790. We are higher by 75 basis points.
You have to admit, Manish, that 715 was unnatural.
Conditions in bond market. So this also could be unnatural.
Okay.
The 790. But the point which I'm making is there are specific nuances of different, announcements which have happened. If you take aside the 25 basis point hike, I would like to mention 3 of them here. Number one is the dip into the SLR for LCR requirements. Besides helping some banks, as Mr. Gupta was mentioning, I think the key message here is the deposit rates or the CD rates which were getting under pressure because the banks had to meet the LCR and they had to issue these deposits or the CDs at higher levels, they would get some respite. So some pressure would be taken off at the short end because of this. And it is very important because the markets were really, really getting out of hand, I would say, when people were not able to raise short-term deposits.
Okay.
This is one part of it. Second thing would be the SDL part, what you mentioned. It will definitely have some kind of a negative implication on the P&L of the banks. But it's a step in the sense which would start differentiating the yields between different state governments, what they are talking about.
Yeah.
Because earlier it used to be marked at the same level of 25 basis points. So that could, you know, lead to some kind of a reform in the state government borrowings also.
Okay.
I think these are the two key issues which I wanted to highlight here.
Okay, can you give me a range for both the under 1 year paper, you know, say the CDs, 1 year CDs, and for the 10-year GSEC?
So range for the future you're talking about?
Yeah, I mean for the next 2-3 months.
Yeah, I think the 10-year bonds definitely should not go beyond 8%, and it should hover around 7.75 to 8 only, because, you know, repo rate is just 6 quarters, so and yields have already moved up. I would actually foresee that the short-end yields might come down a bit, which had gone out of hand. You know, CDs being issued at around 8% when repo was 6 because of the liquidity pressure. So a combination of surge in liquidity back to some kind of normalcy, and with this LCR benefit, you might actually see short-end rates coming down a bit.
Okay, okay. Well, then let's go to the man who is more looking to borrow from the wholesale market. Mr. Umesh Revankar, do you think at least there is some temporary relief for people like you? You can borrow at the short end a little more cheaply. What are your takeaways from the policy?
See, rates have been going up for last 2-3 months, and it was anticipated that RBI will raise the rates. So anticipation is there. I think people are relieved. It is not 50 basis point. That's the one thing I should say. But however, the raising money, I don't think there is a big challenge right now. We should be able to raise, and only thing is the increase is already factored in, and we have been witnessing it for last 2-3 months. So I think passing it on to the end customer is something which we have already done to some extent, and I think we will be able to do it reasonably, because the demand is quite good. Since the demand is good, we will be able to pass it on to the customers.
Okay, that's good to hear. Gentlemen, I have to take a mandatory break, but I'm coming back and I want to know how you all read the future from this policy. How many more rate hikes? What can that do to growth? And what can that do to demand in the system? To what extent can you pass it on? A look at the future, a peep into the future from our experts when we come back. Welcome back. The Reserve Bank's Monetary Policy Committee has just announced a policy that would perhaps get a AAA for the manner in which it has managed expectations. There was a rate hike, but the policy remained neutral, and therefore the markets are not spooked. But of course, all these are tentative judgments on the policy. One will have to wait for the Monetary Policy Committee's minutes, but this time around perhaps it won't be a jerky surprise like it was last time, because after all, the vote was unanimous. So it's unlikely that there will be too many nasty surprises in the minutes. Sajid, to you on that, rather than the minutes, I wanted to know whether the MPC has slightly overestimated growth and slightly underestimated inflation.
So, you know, again, these are judgments we all have to make. Our own sense is that growth may not be as strong as the MPC forecasts for a number of reasons. I think if oil stabilizes around 75, that's a meaningful adverse terms of trade shock compared to last year. It's almost 30%. Number two, financial conditions have already tightened meaningfully in the last 2 quarters, and that will have an impact on activity going forward. And number three, we're still in the middle of a deleveraging process, so we don't foresee bank credit growth picking up in any meaningful manner. So our own sense is that growth will, go from 6.7 closer to 7.1 next year, which is less than what the MPC estimates. I think the key, however, Lata, is to look at where inflation is going to be in the first quarter of 2019. I think what some may have missed is the second half forecast was marked up to 4.7. But there are two important distinctions here. for October to December has got strong base effects which depress inflation. So implicit in that markup is the fact that Jan to March is now forecast to be above 5%. And I think that's the key here, that the MPC is implicitly telling us that it sees inflation in Jan to March quarter, which is the first clean quarter of inflation without any base effects.
But this is X of
5%.
this is X of MSP, isn't it? Sajid, this would be X of MSP. So if once you know the MSP number, there is an upward bias.
So even that's right. So those were the 2 points I was making. That number one, once you adjust for the base effects, Jan to March inflation is now above 5% in the MPC's judgment. And number two, that this does not have the MSP increase. This tells me that despite the fact that we think growth doesn't pick up as much, and therefore I don't think the kind of momentum you saw in core can continue forever, despite that slowing, I think the MPC will have to move again. I think we've seen that they've been very data dependent. Whether they move in August or October, I think will come down squarely to where is core inflation in the next few months and what happens to oil prices. Our baseline cases, having moved in June, the MPCs bought themselves some space. I think by October, we'll have a much better read on the monsoon and on the MSP increases. So our baseline cases, you get one more rate hike in October, but that could easily move up to August if the next two data prints have very sharp core momentum.
Okay. Well, that's important that there are upside risks, and these are excluding MSP. And now Sajid points out to something else, that actually for the average of the second half readings, the bulk of the inflation numbers are going to come in the Jan-March quarter. So that sounds a little scary. Mr. Gupta, on an altogether different note, this munificence or forbearance given to MSMEs, now they can default or take 6 months to pay back their loans. Is that a good thing, really? I'm still worried that the system may not have coughed out all the demonetization-related problems and the GST-related problems of the MSME. So is this forbearance legitimate, or will it just push the can ahead?
No, I think this is very important. See, last time when they had brought in this, that was only for 1 quarter. So what they have done is they have allowed it for a year more, actually. And there again, there is a difference between the MSMEs who have a GST and registration and those who don't have. So one is that I think the attempt to push all the MSMEs to go in for GST and registration. And there again, it will be withdrawn over a period of time. The fact remains, yes, MSMEs do face a lot of problems, actually. I mean, post-demonetization, GST introduction, they have been facing problems. So I think this is a very good move. They needed some help, actually. I think so we will be able to continue the dispensation which had come last time for 1 more year. So I think this will be very helpful for both the banks as well as MSMEs and for the economy as a whole.
Okay.
So
what is the percentage of the industry's exposure to these loans? Approx?
No, I don't think the amount is very small, actually. To tell you the truth, actually, when the last time this dispensation had come, quite a lot of people were not even willing to take it, actually, because it was available only for 1 quarter. Okay. That now that this will be available for a longer period, I guess people will be taking it, because for the banks earlier, it didn't make sense, actually, to, you know, not classify an account as NPA on March and then classify again them in June, actually. So this is now much, much more meaningful. So this will be used by everybody.
No, I'm just afraid that I hope we don't get a shock at the end of next January, because you know, there could be accumulated NPAs. You don't worry that.
No, but they have said that it will be withdrawn in a gradual manner post-January also. Only for the people who don't have the GST and registration, it falls off. But for the others, there will be a gradual withdrawal of this facility.
This PSL norms getting tweaked, will that make a big difference? Do you expect a lot of demand from the housing guys? Good competition there?
It will actually. In fact, that is again a very big relief which has come to the banks. This is something which, in fact, we have also suggested, actually. See, there were a lot of different definitions of affordable housing, actually. So what it does is actually it aligns quite a lot of those definitions actually. So, and moreover, given the increase in the cost of housing also, so I think the definition which has come out now is very good. So this will surely help the banks to achieve their PSL targets also, and also focus more on the housing. As you know, that the housing sector, the demand, of course, post-RERA has been good. The whole portfolio has got risk mitigated. So the bank should be able to lend much more in this segment going forward now.
Well, Mr. Revankar, look what the bond guy and the economist are telling us, that the inflation is going to be higher than what the RBI has forecast. So Sajid is forecasting more rate hikes, and Manish anyway is saying that the upper end is going to be 8% plus. So how's life changing for an NBFC company like yours? Does it get a little tighter and more difficult? And also, how do you see growth prospects?
See, the growth prospect looks quite good right now, because most of the the government expenditure has been quite high because of infrastructure, and in the past most of the infrastructure projects the private players were part of it, and this time around the government is directly giving EPC contracts. So that means government is spending, and it remains continuous. So it will not be disturbed, because some private players suddenly backing out or not getting clearance, not able to execute it. This kind of a challenge is not there. So government expenditure remains high. So the demand for the credit will remain quite good, especially construction related vehicle and equipment. The second is the monsoon being predicted well. I feel there will be widespread, if there is a rain is widespread, then there could be good demand from the rural, both consumption and demand. See, when the consumption goes up, then definitely there will be movement of goods and movement of vehicles, and demand will be there. So demand seems to be reasonably strong. And cost of fund, yes, I do expect some increase, because we would be focusing on more of retail raising. Because the last 3 years we have not raised any retail money through bonds or deposits. Now this year we will be focusing on that, and retail being costly by around 50 basis points. To that extent, the mix will change, and but we'll be able to pass it on to the customer, because the demand is quite strong. When the demand is strong, it is easy to pass it on.
Well, that's the time when the retail investor also should be able to, sift the men from the boys when they are investing in the NCDs. But Manish, a very quick word from you. Deepening of the bond market. I mean, they've paid attention to the when issued market increase, or promised the increase of short selling. Do you think it's delivered somewhere in even evolving the bond market?
Yeah, Lata, a lot of pragmatic steps in terms of, we are yet to see the details about the short sale, the when issued part, even on the SDL's part. So all these things are perfectly fine, and we welcome them. But I think somewhere down the line, the regulator would need to address the kind of, fractured markets at the moment in the system, which is very Manish, important for us.
Manish, I'll disturb you on that.
Dried up, and Manish, I would say 60 to 70% of
let me interrupt. Were you disappointed that you didn't get any clarity on OMOs?
Go ahead, Lata. No, not at all. Not at all. Because I think OMOs will happen over the period of year. As we don't get the liquidity, the primary liquidity through the FX part this year, as we can see that I don't think so anybody's expecting inflows. And on the other side, the currency with public is expanding at a very large pace. So that would be the only source of primary liquidity. That will happen. Though the timing is unknown, it could be second half. So I don't think so we're disappointed at all. And I think DG Acharya made it very clear, if we are going to be lending, the banking system is lending 90,000 crores. Don't expect OMOs now. So I don't think so that is going to make a difference. I will still say the important thing is 60-70% of the market is not participating. The risk-taking ability of the system is quite low. We need to address that, and I think that would be more important in the next 6 months or so.
Okay, that's that's the area or assignment given to the Reserve Bank for the next 6 months. But just to stick with the policy, I think it's delivered on many fronts. It's managed to put a little more liquidity to banks who care to lend. It's managed to increase the depth of the market a little bit. It's managed to give some succor to MSMEs, some succor to affordable housing. And above all, I think it's a great negotiation to be able to get all the MPC guys on board and say one rate hike and neutral policy. Looks like they will manage without too many shocks in the minutes as well. To that extent, I think the policy and the adjacent announcements deserve a AAA today. Gentlemen, thank you very much for joining me on the special coverage of the Monetary Policy Report.